Good morning. Welcome to the Brew. I'm Lex, your host. Today we have a very special guest, Mr. Brett Friedman from Winhall Risk Analysis. We're going to tackle, or he's going to tackle, the January barometer and Valentine's Day effect, commodity price declines, and that stubbornly high gold commodity as well. So tune in to the opening bell. Good morning, folks. Molly, Brett, welcome to the show. How are you?
Good morning. Thank you for having me.
You bet. Good to see you. So, Brett, you are from Winhall Risk Analytics. I think it said analysis. I could have been wrong about that. I see it's analytics on the notes. Molly, that's my fault. Shocker. Brett, tell us a little bit about yourself. Tell us what line of the world you're in relative to, investing and trading and all that kind of good stuff.
Well, I started my career at the Federal Reserve Bank of New York trading foreign exchange when they traded foreign exchange, when they were intervening in foreign exchange markets. From there, I moved into trading petroleum and all of the products. And from there, I moved into risk management. I've risk managed or traded most asset classes except fixed income. I was the chief risk officer for Osprey Management, which at the time was the largest commodities hedge fund in the world. And I've been running Winhall Risk Analytics, which is a risk management advisory firm for the last 10 years. So basically, I'm a natural resources and equity risk manager.
Okay, good. And how long have you been doing that, you said?
Most of my career, since the mid-90s, I've been a risk manager or a trader or vice versa. So
yeah, I like to call myself a risk manager too, but that's another story. I like to put the risk on and someone said, take it off. Right. So yeah, that was you, right?
I'm more of the risk management version that somebody is walking into the casino and and I think that they're probably going to risk too much. And I tell them, you can go bankrupt. And they go, maybe I want to do it anyway. That's hedge fund risk management. Not
I gotcha. All right. So we're gonna chat. You're gonna chat about the January barometer and Valentine's Day effect. Okay. So I don't even know what that means yet. Do you have a particular order you want to go? You want to start there and go down the commodity price decline? Okay.
Yeah, we can start with the January barometer.
Okay. Tell us what that means. Tell us the whole gang what that means.
So I'll just group them. The January barometer and Valentine's Day effect are two of a large class of these sort of simplistic metrics that people like to lean on. The January barometer is, although there's a couple of variants of it, it's essentially what happens in January is indicative of what will happen for the rest of the year. So if January is up, the rest of the year will be up. Okay. Nothing much more complex than that. Some people say if the first trading day of the year is up, then the rest of the year will be up. But it's basically what happens in January happens to the rest of the year, however you want to divide it up.
Okay. So that being said, I think we were up in January, if I'm not mistaken. I think this is from memory. I don't know this exactly, but I think it was probably from memory. I think January is a pretty good month. Is that accurate?
Yeah. So from that, they would be saying that the rest of the year is going to be up.
Okay.
Now, what we did was we went back to 1996 for the SPX, for the S&P 500, and tested whether this is true or not. We just applied the rule to every single year. It's not true. I mean, 46.5% of the time it predicted a positive return. So in other words, if January is up, only 46.4% of the time was it true. But more to the point, we did the same thing for February and March, just to see. And we got very similar results for February and March. As a matter of fact, March was a better predictor than January of what the rest of the year is going to be about. So this is more or less, I mean, first of all, if January is up, the rest of the year is up. That's probably more of a function of the fact that we've been in an extended bull market for a very long time. Right. I mean, 96, I think 75% of the years have been up. So it's not a great shock that if January is up or any particular component of January is up, the rest of the year is going to be up because we've been in an extended bull market. So as with all of these things, it's important to take to be very careful with these things, that if it were true, this would be a very easy game, and people lean on these things for comfort more than anything else, because it's easy, and off we go to the races.
Sure.
The Valentine's Day effect is sort of similar.
Okay.
And the idea is again, there's a whole bunch of different variants, but basically about 5 trading days before Valentine's Day, you buy the market and you sell it on Valentine's Day or the day after.
Okay.
Simple as that. The idea being that Valentine's Day is sort of like a mini Christmas. People are buying stuff, and it gives a little shot to the market. Again, not true. We went back in time to 96, and we took the SPX. We simulated 1,000 random 5-day trading periods, just 1,000 of them, just however you want to do. And the results were 46.4% of the time. The random results beat the Valentine's Day period. So, it's not really it's as true as any 5-day trading period, frankly. Sure. As in all of these things, it's a simplistic way of looking at the market. It gives a lot of screen time to various YouTube characters, but essentially, trading's a hard business.
Yeah, no doubt. No doubt. Yeah, interesting. So we almost would have gotten it right this year for the Valentine's Day effect, except Valentine's Day is tomorrow, and we missed by a day because today's the big sell-off. It looks like the SPUs, I call them SPUs, the SPX is down about 64 points. So if we had shifted one day over, we might have hit this one, because we were up pretty good for the last few days, right?
Yeah.
So just missed. Oops. Story of my life. Timing is everything. Molly, you're so quiet over there. I know you're here. It's not a doll, right? It's really you.
Right. So I just on a comment that you made, which is great. I've heard you say that before, where back when you began, there wasn't the input of the retailer, and there's a lot of noise out there that's actually affecting the markets. So you call it the volatility of the volatility, which I thought was really great. Can you speak a little bit more about that, and how you see that evolving, and will it level out, and will people become more informed? And if not, where does someone go seek the signal through the noise? Where do you
The good news is that unlike when I first started, data was very hard to come by.
Yeah.
And there weren't now you get on the net and you can get year-to-date returns. You get whatever you want if you just dig a little deeper. So to me, if I were a retail investor, when you read about these rules, you can download data, you can stick it into Excel, and it's a 3-minute, 4-minute process to figure out whether this is true or false. You can download 20 years of data, whereas a couple of years ago you couldn't. So it's really important, I think, as a retail investor, to realize that there are no easy ways of making money. If there were easy ways of making money, first of all, I wouldn't be telling you what they were. All of these internet channels, I just don't understand it. Make 300% in 2 days. It's just not a viable way of trading long term. But it does produce clicks, and it is kind of interesting to look into some of these ideas.
So, some of our viewers are just starting out. So walk them through. So you say download data. So where would you go? So give them, a URL. What's your go-to? You get your coffee in the morning, and where do you go do your sleuthing?
Even if it's Yahoo Finance, right? I gotta be honest. I click on that one a lot. So
Yahoo Finance works fine. Google works fine.
Yep.
The one I use, because I'm affiliated with, is OptionMetrics. OptionMetrics is my go-to source for all of my data, because it's great data. It's implied volatility data, which is kind of hard to get.
Right.
Very difficult to get. But for underlying stuff, price data, it's readily available on the internet. It really is. You just type it in and you'll get 50 sites that are willing to give it to you for $6 a month.
Okay.
Or free.
Right.
So
Right.
That's awesome. That's really good. Okay, good. So let's move along to the next topic. Okay. Which is the commodities price decline. Now, full disclosure, I don't follow commodities very much unless there's some option I can trade on, which I know there is. But this is my weak zone, so I'm eager to hear about this. What's going on with the price decline?
Okay.
Generally,
so this is one of the reasons I focused on this is that I look at things in the market that people aren't really looking at or aren't getting, in my opinion, aren't getting enough press. And commodity price decline, commodities, if you want to look at a broad commodity indexes, that's the Goldman Sachs Commodity Index or the Bloomberg Commodity Index, GSCI or BCOM.
Okay.
Both since June have been coming off heavy since June of 2022. So all of us, so we're coming up on 2 years now of more or less steady monthly declines in commodity prices. So like the GSCI since June of 2022 is down 31%. BCOM's down 28.1%. The energy component of the GSCI is down almost 39%. Industrial metals are down 18.5%. Now, why is this? A friend of mine said, "Who cares?" So the answer is that people use commodities to make things. You burn it or you're converting it into something else. And the reason you're converting it into something else or burning it is because you're part of the economy and the economy is growing. If that stuff is getting cheaper, it's because people aren't using it as much. So to me, there's two things going on. There's, first of all, China's a big user of commodities. Their property price, their property sector implosion, if you will, has caused them to cut back on how many commodities they buy, because when you build houses, you use a major amount of like copper and things like that. So that's one of the reasons. But if you had been looking at this over the years, since June of 2022, like if you looked at it last year and you saw these declines, you'd say, maybe, these rosy pictures of future economic growth, especially from China, aren't as good as are being publicized. Maybe this is worse than we're thinking. China is not the only thing that affects the commodity index. It's the rest of the world as well. So to me, when I look at the commodity indexes, I go, I don't know whether the forecasts that are coming up in 2024 for the US or for Western economies, they might not be as great as we thought. And specifically, maybe inflation is being overhyped in the market because, we saw this morning it came off a little. But, if you'd been looking at the commodity indexes over the last year or so, you would have said, I don't know what, inflation seems to be coming off as far as, as a commodity price driven indicator.
Right.
But more to the point, if you want to see slide 1.
Okay, slide 1. What is this showing us, Brett?
So GSG is the GSCI ETF trades. And you can see that the implied, and there's options on this thing, albeit they're not great, they're not deeply traded, but they're traded.
Okay.
You can see the implied volatility of these options has been more or less steadily coming off since June. And if you go to the next slide, you can see the various componentries of this. This is in all points. So you can see natural gas implied volatility has just cratered since June of 2022. Okay. Now, what does this mean? To me, it means that, commodities are quiet, that they're complacent with prices coming off, and that the geopolitical tensions that are going on in the world, some of which that are huge, are not having an effect that you would think on commodity prices, specifically like energy. I mean, everyone, they're saying energy came back, crude oil came back a couple bucks because of the geopolitical tensions that are going on in the Mideast. But the rises are marginal, gasoline has been coming off pretty good too. So, and more to the point, like agriculturals, like wheat and corn and things like that, have been coming off despite what's going on in the Ukraine, which is one of the major bread baskets of the world.
Right.
So commodities are just kind of like shrugging this off.
Mm-hmm.
And to me, that means that they're massive oversupply, or they're just too complacent about what the geopolitical situation can do to commodity prices. It's probably a combination of both, frankly.
Yeah. So that last slide that you showed, those were numbers based on implied volatility of those indices, not actual movement of them. Is that correct? I just want to make sure I understood that.
So negative 10.3 would mean, like, for example, if the volatility were 50 at the beginning of 50% at the beginning of the period, and then it was 39.7 at the end of the period.
Okay. So this is implied volatility then. Okay.
Correct.
Okay. So not movement. And then the implied volatility collapsing means lethargy in terms of interest in these sort of.
It means lethargy. It means that the price swings are lower. It means that the returns are lower. It means that the standard deviation of the swings, the standard deviation of the vol is also very low. It's just like, this is, if I looked at this as a trader, I'd say this is dead market. There's not much to do.
Got it.
But I'd also be a little scared that, this thing's been coming off for a long time. Is this thing going to pop one of these days?
Yeah.
So anyway, to me, it's something, for retail investors or for investors, it's not, the connection to growth is kind of imperfect, but it's another thing to keep in mind that you don't really see elsewhere. Commodity prices are coming off hard, and have been for a while.
Yeah. Okay. So, and you mentioned something about inflation along the way here. So I just want to make sure I get this. Prices were massively elevated, toward, 2020 and beyond, right, for a while. And then we've seen them subside. So, and you mentioned inflation as well along the way here. So are we seeing this massive demand early on, massive inflation? People are saying, okay, I don't need to pay this kind of number for these stupid commodities anymore. They're not really stupid, but you know what I mean. So I'm just backing off, period. And you mentioned China. I'm sure the U.S. has a massive, supply center for these types of commodities as well. So is it kind of the effect of, whoop, we went up, and guess what? Lo and behold, we got to a point where no one is paying these prices anymore. Forget about it.
I mean, in the case of, as I said, I mean, you can connect it to inflation. The correlation is imperfect, as it is in most of these indicators.
Sure.
That's the dirty little secret.
Mm-hmm.
You come up with growth estimates in your opinion about growth and various other economic fundamentals, not from one indicator, not just from commodity price declines, but from a whole suite of them.
Sure.
Similarly, you don't drive your car just by looking at one gauge. You're using a bunch of different gauges.
Sure, understood.
So commodities have been coming off for a long time. I mean, that has implicated, and that's not bullish, as it were, for inflation. It's it's indicating lower prices.
Mm-hmm.
And in a perfect world, if I were saying that the economy was going to expand, which would you prefer? Commodity prices going up or commodity prices going down?
Mm-hmm.
I prefer commodity prices going up because it means people are buying, are using inputs to make stuff. It's as simple as that.
I got you. Okay.
And then I would just ask the question. So this is coming from a blonde, 2 retailer. So this is for you to squash any hypothesis that I'm throwing out there. But so we see, BlackRock making deals with Zelensky as far as loaning.
Here it comes. Put your seatbelts on.
Right. Ukraine historically has really coveted and not allowed external ownership of their land. They have a lot of resources, as you say. So as this outside geopolitical pressures coming in, they're having to open up, and BlackRock is stepping in with other investors. Franklin Templeton was one of the first ones back in 2013. So are the markets anticipating that now there will be additional access to these resources and start to pull these out of Ukraine? And that's why that market isn't budging?
I don't know.
Well, that's honesty, Mo. We don't get that very often.
No,
But
let me back up, because I mean, Ukraine has always traditionally been, I mean, they're one of the world's largest exporters of wheat and sunflower oil and things like that, and they've always have been.
And by the way, here's a fun fact. Sorry to interrupt. I do that a lot. Lex should have forewarned you. I apologize.
No, it's fine, and I get this all the time.
So this is really interesting. But they're one of the largest owners of mercury, and so they have a hadron collider has now been able to convert mercury into gold. And then, so it might be a little bit radioactive, but with bricks, great. There's a little there. But bricks, with gold back, CBDC, and then that mercury stash. I don't know. What do you think?
Where do you come up with this? This is unbelievable. Unbelievable, Mal.
I have no friends. I don't get no friends.
She grows commodities.
I can get into this when I talk about gold.
All right.
Okay.
All right. Put it on the burner for a second,
Right.
but my God, it sounds like you grow commodities.
I can say that they're, for broader commodities, for energy at least, is that the sanctions have been incredibly porous, and that there is supply, and Russia is getting their supply out of the country and selling it within their little, to China and things like that. So it is porous. So the sanctions are not having as big of an effect, or having any effect, I think, on world oil prices. So
Right.
like I thought it was. So,
and like for example, and we saw that in history. So we weren't allowing Chinese steel in, but they came in through Canada. So they'd sell it to Canada, and we buy Canadian steel. And so that it always moves around somehow.
yeah, exactly. I mean, not as easily, but it moves around.
Right.
Let's move along to gold. I love gold. Tell us, it's stubbornly above 2,000. Is that about where it is? I mean, it seems like it's always around there.
Well, it hasn't always been around there. It's been around there off and on since I'd say about June of 2020-ish.
Oh, okay. The longer than I thought, actually. I was
So it goes up over 2,000, hangs out a little, then comes off, and goes back up, comes off, comes back up. And currently we're in one of those phases where it's hanging out over $2,000. It's interesting with gold, because the popular perception of gold volatility is not accurate. It really isn't. And people think that gold is a very volatile commodity. It's really one of the least volatile commodities we have that you can trade. I mean, we're talking about implied volatilities of like 17%, mid-teens.
Sure.
And they don't move around all that much. So, I mean, we're talking about, on a $2,000 commodity, we have daily price swings averaging about $10. Daily returns average about like 80 basis points. I mean, compare that to natural gas or something where you have volatilities in the hundreds, and giant daily price swings and stuff. So gold is, from an implied volatility standpoint, or from a volatility standpoint, it's a very sleepy commodity. It really is. Despite the amount of attention it gets from conspiracy theorists and amateur gold traders and everything else, it is a relatively minor subset of the commodity world. It really is. I mean, but there are people, there are gold people that all they do is trade gold, and they're really into it.
Yeah, no kidding.
And so, but what's been going on? So, currently you can say that gold's over $2,000 because of geopolitical tensions. That's one of the drivers of gold. Interest rates are one of the drivers of gold, as is inflation. But they kind of come and go as far as whether the fundamental is having an effect on it or not. Like in 2022, gold is supposedly a great hedge against inflation. Gold came off, and inflation was going up. So sometimes gold doesn't just react rationally or how it should, which is one of those things that people lose money are usually, it should have done this. Well,
Right. So let me ask, is this a warning signal to you or not? Gold being this stubbornly, I don't know about stubborn is the right word, but 2,000-ish. Is this a warning sign to you? Is this a leading indicator of something?
No, to me, I'm not a gold guy. A gold guy would probably say it's a harbinger of the end of the earth. To me, it's just like it's over 2,000 for various reasons.
Uh-huh.
You know, central banks have been buying gold. Who knows why they're buying gold? But does this have an effect on the world economy or anything like that? Or if not really?
Not really.
It's just sort of an interesting market anomaly, more to me, more than anything else.
Right.
There,
The reason I bring it up is because just to dispel the notion that gold is not a volatile commodity. It really isn't.
Yeah.
And you would be seeing a lot more action in this, I think, if it really were a volatile commodity, you'd see a lot more people trading it. But as is, you have a core group trading it, and that's it.
Mhm.
One of the other reasons I think people say gold is kind of dead, has low volatility over the last couple of years, is that Bitcoin is kind of like siphoning off some of the people that don't trust hard currency,
Sure.
don't trust the U.S. dollar, paper currency.
Mhm.
Bitcoin siphoning some of these people off. There's a whole world of this stuff going on.
Mhm.
So,
you had a great article that I read about the defense of the dollar, that this has been tried before. Good luck. Can you just speak a little bit over this historical attempts and why it just people are concerned with CBDC and all, and
yeah, it's been going on mostly. It's also in energy. That in energy they've been moved because energy is denominated in dollars. It trades in dollars,
Mhm.
and Russia and China have been experimenting with we're gonna trade this in other currencies. They've been making pitches to the Mideast to do that as well. Uh, Most of this is because of the sanctions that were put on right after the start of the Ukraine war, where we froze the Russian assets. And all of these other sort of semi-bad actors said, boy, if they did it to us, they can, they did it to them, they can do it to us.
Mhm.
So it's been percolating for a while as to we really need to move out of this system that the U.S. dominates.
Brett,
But currently it's I believe over 50% of world trade is denominated in dollars.
Mhm.
It's going to be a hard one and besides the fact, if you don't use dollars, then you're using something else. And you're using the something else that is being easily manipulated by governments that, just frankly aren't too cool. So
right?
be
And
careful.
I always say, if the CBDC over BRICS is backed by gold, but no one really audits that. So,
That's the dirty little secret also of just to backtrack, just to get very broad. Chinese statistics,
Mhm.
GDP statistics and stuff. I don't know whether these are true or false, frankly. They're not audited. They can say whatever they want. I don't know whether it's true or not. So whatever's bearish, I usually figure is a lot more bearish than it is.
Mhm.
And the bullish stuff is probably less bullish than it is. But it's more or less, I think the direction's probably true.
Right. So if a retail trader investor wanted to get into the gold market easily, is there an ETF that's one of your favorites? Like GLD, I know exists. Is that
GLD? Then there's also a whole bunch of gold mining stocks, which mirror gold pretty well.
okay?
The problem with the gold mining stocks, then you have operation, like if the gold miner has an operational problem, then you have that on top of your plate. But they more or less mirror gold. Okay.
Yeah. Okay.
Of course, you could trade gold futures if you want,
Right.
which isn't that difficult. It sounds more daunting than it is.
Right. Right.
So
So it sounds like gold to you, at least, is a little bit like the porridge, Goldilocks porridge. Not too warm, not too hot, not too cold. Kind of,
it's not something, frankly, at a certain hedge fund I once worked for, we used to have a Monday morning meeting and we would all pitch our trading ideas for the week.
Yeah.
And the PM would listen to them. And at the end of the meeting, he would say, okay, this is what we're going to do. I remember somebody pitched an idea and the PM looked at the wall and said, so I opened up the Wall Street Journal, at the time was paper, and said, so of all of these pages, of all of these instruments, this is what you want to do. This idiotic trade, this complicated trade is what you want to do. Out of all of these pages, it's kind of a mediocre to me. Currently, it's kind of a mediocrity. I don't really see much action going on there. I could think of better trades.
Okay.
For because the object of trading, it's allocation of scarce resources. The scarce resources is capital.
Mhm.
Is this where I want to put capital? Probably not.
Probably not. Okay, gotcha. Interesting. All right.
Mhm.
You know, Molly, I'm going to come up with something on GLD before it's all said and done. You realize that, right?
I do know that. I do
Yeah.
realize.
Yeah. So you watch. Okay. Awesome. Molly, any last parting questions
Of
for Mr.
course.
Friedman?
What kind of question is that? Of course,
Well,
I
I
have.
know,
I
but
have
that's
so many
my-
questions for. I was
that's
so
sort of-
excited for this,
I know.
to meet Brett.
That's
But
my
you-
indication to you, Molly, that wrap it up, kid. Okay.
All right. So you mentioned a GPR, geopolitical risk index, at one point. What do you think of that?
You must have read my stuff. Congratulations.
Are you kidding me? She
I
doesn't
don't
sleep.
What was it? That's an index that was it's two college professors came up with it. And
Yes, exactly.
I forgot how it's driven, what makes it go.
It was just a blur. You just gave us a teaser, so that's why I wanted to ask you about that. That was really
Oh yeah, I remember. Sorry. So they take news report, they take all the news and they kind of scrape.
Oh, that's right. Yeah.
And they kind of rate it, rank it, and they come out with a score. And the score is, I think it starts at 100 and it goes up and down from there.
It was the top 10 newspapers, I think.
Yeah, I think it's something like that. And how often is this mentioned? It's pretty interesting in that when geopolitical tensions happen, the index spikes, but slowly but surely it starts coming off. Like if Ukraine's a perfect example. When it was beginning, it was hot and heavy. And then when something else happens, it distracts everybody and everybody goes, it gets relegated to the second page, below the fold, at least.
Right.
Used to say. So it's an interesting index. For if you think that geopolitical tensions are rising or stuff, it's a great way to see, are they indeed rising as far as the press is concerned.
Mm-hmm.
Right.
I sort of in a little bubble, and all I'm concentrating on this all day is like I'm looking at news and getting completely crazy. So you look at, like I have to get into the bunker versus looking at this index, which is a little bit more objective as to whether it's actually moving up or down. So.
And you talk about volatility not being where it should be because people, and it does fall off with geopolitical issues. Are people just getting used to doom and gloom? Is this a way of life now? Is that why?
That's a great question. There's this, in my opinion, volatility is probably a little pumped more than anything else because over the last couple of years, because people, when I started, honestly, we got news, but we got it over the ticker. And it wasn't this 24/7 constant barrage of news where we're getting information 24/7 every single day. And I think that makes people much more anxious about what's going to happen than in previous years. I can't even, can you imagine what social media would have been doing during World War II?
Oh my, that is such a good point.
Or during the early,
never thought about that,
where it wasn't completely clear that we were going to win. Can you imagine what would have been going on?
The missile crisis. That whole bluff would have just been shot.
Yeah. So that's why I think it might be a little pumped that everything is a crisis. Nothing is just normal, and it flows into the market as well. And so, what's interesting I'll digress for a second because I'm going to write about this week, and I was looking into it yesterday. The so-called Magnificent Seven.
Mm-hmm. Oh, Molly! Now you're talking Molly's language. Here we go.
Not the Yul Brynner movie. So with the Marlboro cigarette theme. But anyway, so those stocks have been, underpinning the broad SPX rise and everything. And I'm looking at the implied volatilities of all those things. And since the end of January, the implied volatilities of the Magnificent Seven of each one of those stocks has come off pretty hard, with the exception of NVIDIA, which has gone basically vertical in the last week or so, the last couple weeks. And that volatility has come up.
Which, by the way, Pelosi may or may not have investments in. I'm just saying.
So
Tough one.
so NVIDIA volatility is coming up, where the rest of the Magnificent Seven, their individual stock volatilities are coming down. To me, that's a sign that the market's getting a little worried that, is NVIDIA turning into a bubble, or was it a bubble, and we're entering into that like crazy Taylor Swift sort of period where the thing is just getting an abnormal amount of attention. I mean, if I were an investor, I'd be looking at that volatility and going, I'm not so sure this is a good idea right now. Whereas the other ones have been coming down because they're more or less complacent. And, they're moving up, but more or less in an orderly fashion. So that was kind of my digression on your news, on the news.
Yeah.
Okay. Well, I'll be looking for that art. You said you're writing about that this week, correct?
Yeah. Right. You have a new subscriber, just so you know, Brett.
Right. So where do people find your articles? How do they reach you?
My stuff is on OptionMetrics. Usually my longer blogs, my more technical, boring blogs are on OptionMetrics.
Okay. And that's .com, right? OptionMetrics.com. Simple
There's
enough.
also OptionStrat.com. I also write for them.
Good.
So that's where all my stuff is. The breezier weekly stuff is on OptionStrat, where I don't write so formally.
Okay. Good. One last question. We're going to let you go, Brett. I promise. So I know you're not an investment advisor and you can't give investment advice. That's the disclaimer that I'm giving right now. But if you were a betting man, do you have a particular favorite direction for the market in 2024? Again, not investment advice, but according to Brett, do you feel up, down, indifferent? I certainly have one, but want to hear from a real pro. If there is such a thing. Again, it's not holding you to this at all, just your curiosity.
I use certain of my friends as a contrary indicator.
That's me, by the way.
Everybody has a friend that's like consistently wrong.
Yep.
And I have a couple people that have been arguing with this bull market now for over a year. And, and they're always, yes, it made new highs, but trouble is right around the corner.
Right.
They're constantly the same way, and they're the same way. So to me, I'm not arguing with this market. It's it feels like a freight train to me, and every time it comes off, it comes right back roaring back.
Yeah.
So imagine, to me, when I'm thinking about a trade, I think, oh, okay, this is the direction I want to be, and then I kind of simulate in my own mind, what would it be like to be short this thing? What would it be like to be short the SPX? And if you think about it, it's a pain in the ass because, you're making every now and then you make some money and you go, damn it, I was right. And then the next day it's like, oh, shit.
I know, right? I've been beating my head against the wall for 36 years. I've been short for 36 years. I swear. Now, I have not lost money because I was in the market making side of the world. So, you could buy bid and sell offers and you could kind of keep swimming. But I always have this short bias. I started 4 months in the industry before the 87 crash. Oof. So I've got that burned in the back of my head somewhere. How that was terrifying. And then the 08 crash was actually more terrifying than I thought the 87 was. Because
people's inbred directions are usually based, in my experience, on what happened their first 1 or 2 years of trading.
Yeah.
To me, the dollar goes up and oil goes down. That's my comfort zone.
I love it.
Anything else is kind of like what's going on here.
Right. All right, fair enough. Hey, Brett, great. Thanks for coming on. We love this. This was terrific. And I got to tell you, Molly, your new #1 fan. Right? I can tell you that. I can tell you already. Molly, good to see you. Brett, great. Thanks for coming on. We will talk to you soon. Have you back again. I'm putting GLD in the portfolio somehow. I can't tell you if I'm short or long it yet, but we'll get it in there. All right. Thanks again for coming. We're going to wrap it up. That's a close.
Thanks,
Brett.
Thank you.
You're welcome.